Welcome to another edition of Inside the Economy. I'm Larry Howes. Thanks for joining me. I want to talk about the U.S. job market and the issue of affordability, which keeps popping up every now and then, mostly the housing. The markets and future inflation, there's some issues going on there. And who's buying and shipping to whom? That entire world market, in light of some of the tragedies going on in the Middle East right now, that is shifting again, and it has an impact. Quick look at the numbers. ISM for manufacturing is still doing pretty well. The boom is not really happening in manufacturing in the U.S. Of course, it's a relatively small part of our economy anyway, but it's not slowing. It is definitely in expansion territory. Some of the other numbers, we had an estimate, the last estimate of fourth quarter GDP came in at 1.4. Fortunately, everybody ignored it. It was supposed to be a lot higher than that. It came in at 1.4, the biggest reason being that the government was shut down for, 40 or so days, had an impact on GDP. There's a big multiplier that comes out of government spending. And the collection of data wasn't all that good. The rest of the interest rates went down. In fact, the mortgage guys were really happy again this morning, saying we can get you a 30-year mortgage just out of the sixes, 5.99, 5.98. I don't think that's going to last. I think that's kind of a sale right now. But we'll get back to interest rates in a minute. There's the 1.4. That was something of a surprise because, and this is the estimate for the fourth quarter of 25. That was like 3.25. Came down, government was shut down. Great. The first quarter of 26, it's going to be 3 anyway. Any theories about GDP, there's going to be a recession or anything like that? No, that's just not. It's a question of how unsoft this, we never even landed. We just kept moving along. And the moving is pretty good. It's looking fairly productive, and we'll talk about how the equity markets dealt with this in just a minute. But jobs, they have been filled. They've been adjusted after COVID. They have absorbed what they can, and the gig jobs have stabilized to where they are. And this estimate here in the gold, they didn't even use the last estimate for GDP in the fourth quarter. They just went straight to 3.5%, 4%. GDP's doing fine, not creating new jobs. That's kind of unusual, but that's where we are. I think what they call labor differentiation, that means some people are absolutely convinced jobs are very hard to find and impossible to get. That's low differentiation. We have low differentiation right now. Jobs are hard to find, and they're hard to get. Those that have them, keeping them, they got their wages adjusted after this inflation cycle. So the job market isn't probably ever going to go back to what we would consider a booming environment again, not for the foreseeable future. There's nothing to do that. There's too much new forces working on the job market. The robotics on the manufacturing side, and AI on the service side. It's going to have an impact on certainly entry-level jobs. And there's a lot of places, even like our own office, which we're having less office space all the time. Interns and entry-level, that's going to be harder. That's simply going to be harder in our industries, in all of them. That's changing. That's just part of the flow. This is commercial real estate, mortgages and commercial real estate. Their delinquencies is really starting to go up. We knew this was coming. End of 25 through 26, this might be 18% before the year's out. A lot of those strip shops, malls, not real attractive office buildings, that kind of stuff, they're not to the point where they're walking away, but there have been a few walking away. And a few going, well, maybe I can borrow some money someplace else. I don't know. Commercial space, That market has changed, and it's not going back to where it was. The equity markets, the S&P 500, this is how we track the Dow, and those guys have just been moving sideways, and they continue to move sideways. Considering all the violence and the tragedies going on worldwide, what's going on in Iran right now, and who's dropping bombs on who, ordinarily, 20 years ago, the market would have collapsed. There's no impact. I can't imagine what sort of impact it would take to have this market really correct, because the fundamental numbers are good. The earnings are just about there. Where this market is valued right now, especially the S&P 500, it's basically almost where earnings are. So I don't see that collapsing. This is actually from the Congressional Budget Office. And they don't often put things like Trump policies on their charts, but this is the Big Beautiful Tax Act. Fundamentally, without really getting involved in that, it's not a very productive tax act. It's got a lot of gestures in it. Oh, we'll save you here, or we'll do this, and some pointless gestures in it. Really don't do anything at all. What we have here is significant government deficit spending, certainly for the next 3 years. It's probably going to add another $400 billion of new money into the system, which is inflationary. And the Federal Reserve is showing no signs of wanting to take that money out. So what we have done is probably add another layer of pressure to hold inflation up while we're spending more than they take in, governments. However you want to look at it, it's not about cutting spending anymore. That's been shaved down nearly to the bone. The government, the federal government, for sure, needs more revenue. It's as simple as that. After COVID and all the rest of this inflation cycle, rents went up, wages went up, wage and hour people, minimum wage. Everybody got an adjustment in what they make because their costs went up, except for the government. And it's not just the federal government. It's certainly the states. All the states except for the Dakotas are looking at fairly grim revenue numbers. Counties, you know the rest. They simply need more revenue. This is going to delay probably 3 years, add a little inflation, and avoid the issue of we're simply going to have to pay more into the system because we probably cannot chop anymore. We're down to the nubs. Leads me to a question which kind of came up. Who's buying our stuff out there? Who out in the globe is buying our stuff? Well, the European Union, far and away, they're the biggest absorbers, and most of that is liquefied natural gas and oil and refined petroleum products. Mexico buys a bunch of stuff because they take it and turn around and sell it back to us at 4 times that, because there's still a lot of manufacturing and assembly going on down there. Canada, that number's changing. They have to buy some stuff. That relationship is changing. China and the rest of them drop off. We're really not an exporting nation, probably aren't going to be. The fact that we're still kind of oil neutral and independent, we'll see how long that lasts. Treasuries have been rebounding. They've been getting more important in the global economy. When the yield comes down, like it has, this is the 10-year, gets below 4, that means the price has gone up. Interest rates across the board went down. Their prices went up. They got more valuable. More people are buying them. Well, they need to. If there's any kind of insecurity out there, well, what you do is you buy a treasury. And people like Europe, especially Europe, England, Germany, Spain, everybody, they've been out buying treasuries. In fact, U.S. government debt, treasuries, is more popular than it's ever been. As fast as China is selling theirs because they need the money, everybody else in the world has been buying them because they need the security. I don't see that changing in the foreseeable future. In fact, the nature of these markets, and this was a question too, oh, oil, isn't that a huge market? Or Bitcoin or all the rest of those, aren't they competing with everybody else? These are the two important markets on the world. It's as simple as that. That is Treasury market. That's about 25 trillion. And the U.S. equities market, that's coming up on 73 trillion. There aren't number twos, really. The entire bond market in China is about 400 billion. Well, the U.S. Treasury trades $1 trillion a day. Okay. On the corporate side of things, there have been some interesting changes. Amazon has finally out-revenued Walmart, which has been targeting for a long time. And as wisely point out, this just isn't on the retail delivery stuff. Amazon has other businesses, Amazon Internet Advisor Services, all kinds of things. But it's not that Walmart has been diminished. It's just that the model at Amazon is growing faster and generating more revenue faster. We'll see how Walmart handles this. It's kind of a big thing for them. And on the other side of the coin, we buy more stuff from Taiwan now than China. That's bad news for China, but that's not going back. Kind of makes Taiwan a popular target for them, but we won't talk about this. That's probably going to continue to grow too. They're going to be a more important trading partner because they're getting really back into the chip business and a few other sides of things. Taiwan and Korea. Cars, appliances, other things. And those two countries, China doesn't do a lot of shadow selling with. So that's kind of productive news. Anyway, what we have now is very resilient stock market, very resilient bond market. Government needs more revenue. It'll be interesting to see how long that takes before that becomes part of the public narrative. But that's enough for now. And as always, questions, send them along to info@shjwealthadvisors.com, and I'm happy to answer them. Thanks for joining me.